Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. This segment is brought to you by the C5 Global Summit. This is a big CCIM NAR event. It's a global event. It'll be September 28th through the 30th, and it's in Atlanta, our headquarters, so you can come see us. I'll give you the website so you can sign up or get more information. It is c5summit.realestate. Well, we have a great show for you today. We're going to talk about the hotel market. And, there's been a lot of discussions around the hotel market, really, with COVID and now with rising rates and redevelopment of a lot of properties. And, we get the opportunity here to talk to some of the finest economists and analysts in the country, but sometimes it's good to talk to someone who's on the front line. Please welcome my guest. It's Greg Friedman. He's CEO and Managing Principal with Peachtree Hotel Group. And here in Studio One, Greg, thanks for being with us.
Yeah, thank you, Michael, for having me.
Now, you guys have hotels all over the country of various types. You develop, you buy, you sell. So I'm interested to see what you're seeing right now. First of all, with performance, overall, how are the hotels? We hear that hotels are just killing it, except maybe convention. What do you see?
Yeah, no, it's a great question. So, performance-wise, it's definitely, rebounded from COVID. Hotels were obviously the hardest hit asset class, just from a standpoint of, occupancy went from being at a record high to a record low at the beginning of COVID. And today, occupancy levels, the actual average daily rates and the revenue per available rooms are pretty much back to where we were pre-pandemic on a macro basis, because we're invested, across the U.S. So we touch so many different submarkets. So we're not necessarily regionalized, although we do have a lot of exposure to the Southeast, Texas, and Arizona. We do have assets, out in California, as well as, some in the mid-Atlantic and Northeast. But overall, the industry is back, and hotels are more profitable in most cases today because average daily rates have grown so much relative to where they were pre-pandemic. So in most cases, our hotels are running, average daily rates that are probably 30% above where we were pre-pandemic.
Nice. That's good to hear. What about the convention-oriented hotels that are in central business districts?
Yeah, so, definitely certain submarkets haven't recovered as well, and the downtown CBD type locations have been slower to recover. So across our portfolio of hotels, fortunately, we don't have as much exposure into some of those downtown CBD locations, but most of those markets are coming back as well. But they're, in a lot of cases, they're still lagging. Like you've seen, a lot of news like out of California, looking at San Francisco, for instance, that market was very hard hit through COVID, and it continues to lag from where it was pre-pandemic. But that's more of an outlier. I would say, most markets are recovering, and the downtown CBD locations across the U.S., most of them are starting to get that convention business, and a lot of them are starting to recover back, or in some cases, they're already back above where they were pre-pandemic.
Yeah. How are lenders looking at hotels today?
Yeah, so it's interesting. I think because we do invest, as a firm, we invest on the credit side as well as the equity side. So we own and operate hotels, but we also finance groups to go out and acquire and develop hotels. So we are a lender as well within our organization. So I think we probably have a different, unique perspective. There's no question, credit has tightened for, not only hotels, but all commercial real estate asset classes or asset types. But hotels are probably a little bit more financeable today, as crazy as that sounds, because usually when you're facing an economic disruption or recession, it's really hard. Hotels are probably the harder asset class to finance, or the hardest asset class to finance, because usually hotels will start to pull back in performance. This time around, just given a lot of the distress in the market, a lot of the dislocation is driven off of just this balance sheet distress with higher interest rates. Hotels trade at higher cap rates, and so they can stomach some of that higher interest rate in the sense that you don't have that negative leverage. So a lot of lenders are actually they have an interest in financing hotels because you don't have that negative leverage factor. Not to mention you have a lot of secular trends that are favoring demand, and just that robust recovery that's giving a lot of lenders confidence to finance hotels over some of the other asset classes. For instance, a good example is multifamily was the favored child during COVID. Like most lenders over allocated into multifamily, in a lot of cases into some of these other lower cap rate assets. And now they're struggling, although there's still capital available for these assets. In a lot of cases, it's tougher for them to finance those asset classes, just given, they trade at such low cap rates and just how fast interest rates have moved up. And then the other side of the equation, just with the secular distress with office, that's created its own challenge because nobody wants to touch financing office right now. So that capital is getting reallocated across hospitality and some of the other asset classes.
What range of equity requirements were lenders primarily seeing before COVID, if you will, and now how much more equity do folks need?
Yeah, so before COVID, I would say most lenders were very disciplined in their approach. Obviously, I would say they were starting to become a little bit, they were easing up their requirements on equity, but I would say in most cases you needed to bring probably 30 to 40% equity on average, pandemic. I would say today you're probably going to need, if you're going to go out and finance a project, you need to expect that you're probably going to have to, especially if it's a new development project or an acquisition, I would be expecting that you would need, probably at least 40%, if not 50% equity to try to get, a lender that's going to provide, really good terms on the financing.
And you mentioned higher cap rates in the hotel world versus some of the other property types, and so you don't have the negative leverage for lenders. What are you seeing for cap rates today overall in the hotel world, and compare that to, say, pre-pandemic or pre-interest rate hikes?
Yeah, pre-interest rate hike. Yeah, and it's interesting because like during COVID, like you take pre-pandemic, hotels were trading around probably for the assets that we buy, typically these premium branded select service, limited service, extended stay hotels, they were trading in that 7.5 to, call it 8% range. In some cases, they were probably closer to 7%. Today, I would say that, and then, during the pandemic, cap rates actually widened out for hotels because there was a lot at the beginning of COVID, because there was a lot of people questioned if hotels would ever recover, as silly as that sounds now. But, at the very beginning, going back in 2020, there was a lot of concerns about the recovery of lodging long-term. And so cap rates actually expanded out. And then, but as multifamily, self-storage, industrial were compressing down to these, record or these historic lows in the middle of COVID, hotels were doing the opposite. And the reason I say all this is that hotels had a little bit of compression in cap rates towards the end of COVID. But as people started to recognize that hotels were coming back, but we never really got that full benefit. And so when you look today across hospitality, cap rates are probably in that 8 to 9% range for the select service, limited service hotels that are that, Marriott, Hilton branded type asset class. So it hasn't moved probably, much more than maybe 100 bips or so, whereas, or even less in some cases. Whereas with some of the other asset classes, I would argue, like you look at multifamily, self-storage, I love those asset classes. I think there's a lot of, great tailwinds, although they're facing some headwinds right now just with supply absorption on the multifamily side. And then you look at what's happening with self-storage as well. There's, it's getting harder to push rents and so forth. But you look at those two asset classes, a lot of cases, those cap rates compress down to levels sub, 4%. A lot of those, assets that traded in the middle of COVID, now the cap rates are probably closer, in my opinion, probably north of 5%, and probably should be closer to 6%, just given where the 10-year treasury rate is today, being around 4%.
Yeah, that makes sense. And you guys do development, and of course we had a rise in prices and labor and materials and everything that kind of went crazy during COVID. Are you seeing any relief there on development and construction costs?
Yeah, we're really not. I mean, we're seeing, if anything, we're not seeing, pricing increase as much, or the cost of materials increase as much, although you're seeing some green shoots here or there where, some of the material costs is coming down. You still have higher labor costs. So you still have a little bit of labor inflation. That's, it doesn't seem to be going away. So I think, ultimately your cost to construct today versus what it cost pre-pandemic, or even in the middle of the pandemic, it's substantially higher. And that's the biggest challenge for the not only the hotel industry, but for all of commercial real estate, is the development cost issue, which is a great thing if you're an owner of assets or if you're buying existing assets, because like take hotels, there's not a lot of new supply getting built. Yet you have all these, you have all these new demand channels coming out of COVID, and you have all these, really just good trends on the demand side that are way outpacing any supply growth. And the same could, probably be argued for a lot of other asset classes, or a lot of other property types within commercial real estate.
So as an example, say a property improvement plan that was done, 3 years ago, that same plan today, is it twice as much? I mean, what's...
Yeah, so it's, take a property improvement plan, a PIP, like that's required by the brand. In most cases, it's probably increased 30%, from what it was going 3-4 years ago, 30 to 40% at a minimum. So it's definitely increased pretty dramatically. The cost on the renovation side, the cost to build new today, has gone up as well. So it's definitely, we've definitely seen a huge increase.
Where do you guys see opportunities in the market today, either geographically or property type? Or
yeah, so we're really leaned into the credit side of the business right now. We're out there trying to acquire hotels, and we are developing hotels, because I'm a sort of a contrarian investor in the sense that it's really hard to develop. And so I guess, I can stomach a lot of pain, and also I appreciate the fact that not a lot of groups can build today. And so we see a real opportunity being able to go out and develop in a lot of these markets where lodging is, there's not enough room supply in those markets. And we can get into a lot of markets today, given the fact that, landowners don't have a lot of opportunities to sell to groups, so there's not a lot of demand for land. And so we've been able to get into some markets that normally would be tougher to, develop into. And so we're focused on the development strategy on the equity side. We're also out there trying to acquire hotels. It's just been a very challenging environment to buy hotels into, and with everything going on, although we've acquired 3 assets in the last, 90 days or so. But we're really focused, where we're putting most of our capital today is on the credit side, where we're actually going out and financing other groups to acquire, develop, or recapitalize their hotel assets, or new hotels that they're trying to develop, as well as other commercial real estate assets. So we're pretty balanced on the property types that we're financing on the debt side, just given the dislocation in the credit markets, which has really caused the regional banks, the community banks, the national banks, which make up 40% of the commercial real estate lending market. They're not unable to lend today, just given the regulatory pressure they're under, given the fact that they're trying to shore up liquidity. And so it's just created a huge opportunity on the credit side that we're taking advantage of.
I love that, and who better to finance a hotel than you guys? I mean, you're going to be able to know what's safe and what's a safe operator, right? And probably even help them with some tips on operation, right?
Right.
You're an investor in that deals.
Yep. No, that's why a lot of groups like to come to us, because we are, as it comes to, we understand the ownership side of real estate. So we have a huge benefit that we understand the ownership side. We understand the development side of it. So if we're financing, new development, if it's a multifamily project or a hotel project, we know the challenges on the construction side. We know the challenges on the renovation side, and so forth. And so we have a huge advantage as a lender, because we can really help not only underwrite the deal and have probably a better, better insight and better, just information on what we think the property is really going to perform at, but more importantly, we can help structure something that makes more sense from a lending perspective. And that's why a lot of groups come to us continuously.
That makes a lot of sense. Some office buildings today are being converted to other uses. We've seen some folks doing some mixed-use vertical, where they're including some hotels. Have you guys seen that, been involved in that, looked at that?
Yeah, we've seen it. We haven't been involved, so we have not financed any mix or any projects where someone's taking an existing office building and converting use, if that's the question. Mm-hmm. So we have seen a lot of groups doing it, and I think it's something just given how much vacancy is across office as groups try to repurpose some of these office buildings. I think it's a strategy that doesn't necessarily work all the time, because the floor plates of some of these office buildings aren't as conducive, or doesn't allow for conversion to like multifamily, which we've seen a lot of groups trying to convert to multifamily, or maybe take some floors and make hotel use as well as have some office use. But I do think it's something, just given how much secular distress is in office, and just how much of how much loss of value and how much discounts are available if you're out buying office today. I think at some point, someone's going to figure it out and be able to be very successful in converting a lot of these office buildings or redeveloping them.
Are you seeing seeing any hotels get converted to residential or self-storage or other uses?
Yes, for hotels, we saw it in the middle of COVID where a lot of groups were converting hotels to residential, to like more of this, almost this this budget, call it multifamily play or, affordable housing, I guess you could argue. We saw a lot of that happening in the middle of COVID. We haven't, we still see some groups doing that as we speak today. The math just doesn't make sense in a lot of cases, but it's a strategy that has worked, and it will probably, groups will continue to be successful at doing it. It's just not as scalable, just given the fact that a lot of the brands, because, ultimately most hotels are branded under some type of franchise, and those franchises tend to be pretty restrictive on allowing you to terminate the franchise and then convert, use to some other, property type or, whatever. So it's something that I think works, but it's got to be in the right situation.
Labor became a big issue during COVID and afterwards for the hospitality industry, and frankly, almost every industry. What are you seeing today? Is that still a challenge?
Yeah, labor, fortunately, it's not as much of a challenge as it was in the middle of COVID. In the middle of COVID, it was as hotel occupancy started coming back in COVID, we were way understaffed, and we were dealing with a lot across our team, because we have about 3,000 team members at the properties that we operate, because we operate about 100 hotels. And then, at the property level, we were dealing with a lot of burnout in the middle of COVID because we couldn't get fully staffed to service the guests. And today, as we sit here, we're still probably about 10 to 15% understaffed at each of our assets, because labor continues to be a challenge. Although we're going through, this, we're either headed towards an economic recession or we're in one, maybe, who knows? It sort of feels like one if you're in commercial real estate right now with everything happening. But with all the, with that being said, it's still hard to get fully staffed. And, labor costs has moved up dramatically. Like when you look at just the average cost of the labor on the, across our team at the properties, at the different hotels we operate, it's up, a good 30 to 40% for each position since, pre-COVID.
Well, what do you expect for the future of hotels to kind of end the show with? What would you share with the audience there?
Yeah. So I think, personally, I believe hotels is probably the best position it's ever been, given what's happened, unfortunately, during COVID, because supply is very much constrained right now. Demand's way outpacing supply. I think hotels, there's just a lot of secular trends with this, work from home or being able to work 1 or 2 days a week remotely has, created this new demand channel for lodging. So I think hotels overall are very well positioned. The fundamentals are super strong. Even if we go through an economic recession, most economists expect hotels will continue to have, positive or pretty close to positive RevPAR, revenue per available room growth. Hotels continue to grow on the profitability side. And so, personally, I believe hotels are probably the most investable asset class today as we look across. And when I say asset class, looking at the different commercial property types, because it trades at higher cap rates. So, again, we trade around, 8% cap rates. So we have more risk premium spread. And unfortunately, a lot of these other these other property types are having to recalibrate their cap rates. And the market is still trying to figure out the right, cap rate to put towards a lot of these assets. And so I think there's a lot of just repricing risk if you're, out there trying to buy assets today for a lot of the other property types versus hotels that have less risk, just given we trade at higher cap rates.
Well said, Greg. Great information,
Yeah,
sir.
thank you. Thanks for having me.
Us. Yeah, thanks for being on. And thanks for listening or watching to the show. We appreciate it. Please connect with us. Please share the show. And until next week, be sure that you always lead, learn, and laugh. And join us for America's Commercial Real Estate Show. Appreciate the show? Consider referring business or doing business with our sponsors. Bull Realty is a commercial real estate sales, leasing, and advisory firm doing business throughout the Southeast, headquartered in Atlanta. Visit bullrealty.com for more information. Commercial Agent Success Strategies provides video training for commercial agents. This training gets 5-star reviews from even the most experienced brokers. Learn more at commercialagentsuccess.com. You're invited to connect with us on your favorite social media. You can find us on LinkedIn, Facebook, and Twitter. Don't miss a show of special interest to you. Be sure and subscribe to the show on YouTube and Apple Podcasts. And at the show website, creshow.com, you can subscribe for a weekly email announcing the show topic and guest. While you're there, you also found more videos and podcasts. Thank you for watching or listening to America's Commercial Real Estate Show.